Have you ever wondered who designed our modern financial system? The one where governments, companies, and even individuals seem to be drowning in debt? You might imagine some secret group in a smoky room, plotting it all out. But the truth is far more complex and fascinating. Our system wasn't created by a single person. It was shaped over centuries by a series of crises, brilliant minds, and pivotal decisions that pushed us down a very specific path. So where does this story begin? Let's travel back to the late 18th century, to the birth of the United States. The young nation was broke, with massive debts from the Revolutionary War. Many thought these debts were a sign of weakness, a burden that would crush the new republic. But one man, the first Treasury Secretary, Alexander Hamilton, saw things differently. He had a radical idea. What if government debt wasn't a weakness, but a source of strength? Hamilton argued that by honoring its debts and paying interest reliably, the government could build trust with wealthy investors. These investors would then be willing to lend the government money at low rates, not just in emergencies, but for building the nation, funding infrastructure, a strong military, and a stable economy. He consolidated the state's debts into a single national debt, creating a market for government bonds. Suddenly, debt became an asset, a safe investment backed by the full faith and credit of the United States. Hamilton laid the intellectual and practical foundation for the modern sovereign debt market. He showed the world that a well-managed national debt could be a powerful tool for state building. Fast forward about 100 years to the late 19th and early 20th centuries. The Industrial Revolution is in full swing. This is the era of the robber barons, and among them, one financier stood taller than all the rest, J.P. Morgan. Morgan wasn't a government official, he was a private banker, but his power was immense. He demonstrated how a massive concentration of private capital could act almost like a government, single-handedly stabilizing or destabilizing the entire economy. His most famous intervention came during the Panic of 1907. The stock market was crashing, banks were failing, and there was no central authority to stop the bleeding. The US financial system was on the verge of complete collapse. So what happened? The government turned to J.P. Morgan. He gathered the nation's top financiers in his library in New York City, locked the doors, and essentially forced them to pool their money to bail out the failing banks and trusts. He decided which institutions would live and which would die. He saved the system, but the crisis exposed a terrifying vulnerability. The fate of the entire American economy rested on the whims of one private citizen. This event scared everyone, from politicians to the public. It became clear that a modern economy couldn't rely on the goodwill of a few powerful bankers. It needed a permanent official institution to manage the money supply and act as a lender of last resort. This realization led directly to the creation of the Federal Reserve in 1913, signed into law by President Woodrow Wilson. The Fed centralized control over money and credit, formalizing the role of a central bank in preventing financial panics. It was a monumental shift, taking power from private hands and placing it with a public-private institution designed to ensure financial stability. The age of the central bank had begun. Now we have the government issuing debt and a central bank to manage financial stability. But the next piece of the puzzle came from the world of ideas, from a brilliant and revolutionary economist named John Maynard Keynes. For most of history, the conventional wisdom was that governments should act like households. They should live within their means, balance their budgets, and avoid debt unless absolutely necessary, like during a war. But the Great Depression of the 1930s shattered this belief. Millions were unemployed, and economies were stuck in a seemingly endless slump. Classical economics had no answer. Keynes provided one. He argued that during economic downturns, the private sector pulls back. People save more, businesses invest less, and demand collapses. In this situation, he said, the government should do the exact opposite. It should step in and spend money it doesn't have, running deficits to create jobs and stimulate demand. This deficit spending, he argued, would jolt the economy back to life. Keynes transformed debt from a last resort into a legitimate, even necessary policy tool for managing the economic cycle. His ideas became dominant in the post-war era, embedding government borrowing and spending deep within the DNA of modern economic management. The end of World War II marked another turning point. The world was in ruins, and the major powers gathered at a resort in Bretton Woods, New Hampshire, in 1944 to design a new global economic order. Led by figures like Keynes and US officials, they created a system to promote stability and prevent the kind of economic warfare that had contributed to 2 world wars. The Bretton Woods Agreement made the US dollar the center of the universe. Every other major currency was pegged to the dollar at a fixed exchange rate, and the dollar itself was pegged to gold at a rate of $35 per ounce. This system created a sense of stability. It also placed a natural limit on how much money could be created. Because the dollar was backed by gold, the US couldn't just print an infinite amount of money. This in turn constrained the growth of debt around the world. But this system had a flaw. As the global economy grew, it needed more dollars to function. But the US gold supply was finite. By the late 1960s, the US was printing more dollars than it could back with gold, largely to finance the Vietnam War and domestic social programs. Other countries, particularly France, started getting nervous and began demanding gold for their dollars. The breaking point came in 1971. President Richard Nixon made a shocking announcement. The United States would no longer convert dollars to gold at a fixed rate. In a single move, he severed the last link between money and a physical commodity. This Nixon shock ended the Bretton Woods system and ushered in the era of fiat currencies. From this point on, money was no longer backed by gold. It was backed only by trust. Trust in the government that issued it. This was the moment the floodgates truly opened. Without the anchor of gold, there was no hard limit on the amount of money or debt that could be created. The world entered a new, uncharted financial territory. So how is money created in this post-gold standard world? You might think it's all done by governments printing bills, but that's only a tiny fraction of it. Most money today is created as credit, primarily by commercial banks. When you go to a bank and take out a loan for a house or a car, the bank doesn't just lend you money that someone else deposited. It creates new money right there on the spot by crediting your account. Your loan becomes a new asset for the bank and a new deposit, new money in the banking system. This means our money supply expands every time a loan is issued, and governments have been playing this game on a massive scale to finance their deficits, which became more common after Keynesian ideas took hold and the gold standard was abandoned. Governments issue bonds. Who buys these bonds? Banks, corporations, foreign governments, and crucially, their own central banks. When a central bank, like the Fed, buys government bonds, it's essentially creating new money to finance government spending. This process is often called monetizing the debt. This architecture created a powerful set of incentives that reinforce each other. Politicians have an incentive to spend money to win votes, and issuing debt is politically easier than raising taxes. Banks have an incentive to create loans because that's how they make profits, which expands the money supply. Corporations and investors have an incentive to borrow money when interest rates are low to buy assets like stocks and real estate, pushing their prices up. And central banks have a mandate to ensure stability, which often means stepping in to buy bonds and inject liquidity whenever the system wobbles, effectively validating all the borrowing that came before. So you see, no single person or group designed this system to be based on ever-increasing debt. Instead, it evolved. It became a self-perpetuating structure where every major player, governments, banks, corporations, and investors is responding rationally to the same set of incentives. The result is a system that is incredibly effective at promoting growth in good times. The constant creation of credit fuels consumption and investment. It's also surprisingly resilient in crises. When a shock hits, the central banks can create vast sums of money to bail out the system and prevent a total collapse, as we saw in 2008 and 2020. But this system has a built-in feature or bug, depending on your perspective. It requires constantly rising debt to function. Stagnation is its enemy. For the system to remain stable, the economic pie must keep growing, asset prices must keep rising, and more debt must be issued. This makes rising debt not an accident or a policy failure, but a structural necessity of the modern global financial system. It's the very fuel that keeps the engine running. Understanding this history is crucial. It shows us that our financial world isn't some natural, unchangeable law of the universe. It's a human creation, a series of choices made over time. And if we made these choices, it means we can also make different ones in the future. What do you think? Is this debt-based system sustainable in the long run, or are we heading for an inevitable breaking point? Let me know your thoughts in the comments below. Please give this video a like and subscribe to the channel for more deep dives into how our world really works. See you in the next one.